Hi, this is Chris Gilliland, Finance 695. This is my presentation for project number 1, investment strategies. The investment strategy that I'm going to show today is looking for a relationship between ROE and a company's stock return. What we're going to do is we're going to perform a statistical analysis to determine if the company's ROE over a period of time is related or relatable to their return on their stock. To do this, we're going to do actually two analyses. We're going to compare the Dow 30 companies, and we're also going to do a industry-specific analysis on technology stocks. We're going to look at 10 companies or 10 tech companies and compare the results with that of the Dow 30 and see if there's any kind of relationship. For this project, using 2012 data obtained from both Yahoo Finance and from Bloomberg. The little bit about return on equity. As we've learned, return on equity is a widely accepted indicator of a corporation's profitability by showing how much profit is generated with the money the shareholders have invested. The equation for ROE is net income over total equity. This is as mentioned, a widely accepted indicator. We've discussed in class that Warren Buffett, this is one of his main things that he looks for when looking for investment opportunities, and Dr. Cresson has touched on this several times. It's one of the things that he looks for and advises to look out for as a good indicator of a company's standings. High growth companies tend to have a higher ROE looking forward, which may lead to want to think that it's a good investment opportunity for a growing company. That being the case, we want the ROE to be high, especially when comparing it to other companies. You're looking for that higher rate of return on equity. The hypothesis for this project, I believe that there will be a statistical relationship between ROE and stock return for the Dow 30 companies. I also believe that this correlation or relationship will be even more evident for the industry-specific companies, being that the 10 technology companies that we're going to look at. I believe that there will be even a stronger correlation between those, since they're all 10 companies are within the same industry, and their dealings and the way that they do their accounting, I'm assuming, will be closer together than the Dow 30 companies, being that the Dow 30 companies span multiple industries and is looked at more of a benchmark for the market as opposed to an industry-specific number. For the Dow 30 companies, what we've done is I've sorted all the Dow 30 companies by their 2012 ROE, and I have them in two columns here. I have the top 15 stocks sorted by ROE and the bottom 15 stocks sorted by ROE and their corresponding 2012 return. IBM being the top ROE for 2012, with Hewlett Packard being the bottom of the ROE. I also have highlighted in red the stock returns of the top 5 companies in terms of stock return for 2012. And looking just on the surface, it doesn't look like our hypothesis is going to hold true, being that Home Depot, which had the highest stock return for 2012, is near the bottom of the list in terms of the top 15 stocks, and the remaining 4 companies with the top returns of 2012 all fall on the bottom 15 of the list in terms of ROE. What we did was, using Excel, I performed a t-test, 2 sample assuming unequal variables, and what we're looking for is to see that there should be a statistical difference between the companies on the top 15 compared to the bottom 15 when sorted by their ROE. And after running this analysis, we see that the p-value is 0.08, which is greater than 0.05, which is what we're looking for to indicate that there is a statistical difference between the two groupings. being our value return of our p-value of 0.08 is greater than the 0.05, so indicating that there is no statistical difference between the two data sets, and disproved our hypothesis right there. Looking at the tech industry companies, again, did the same thing. I chose 10 companies. Some of them were included in the Dow 30 list, such as IBM, Microsoft, and Hewlett-Packard, and also added Apple, Yahoo, Dell, Google, Oracle, for instance, and sorted them again by their ROE. So had the top 5 in this column and a bottom 5 in this column, and again ran the same 2 sample assuming unequal variances test using Excel. And the p-value on this return, or on this test rather, is 0.16. So 2 times the p-value of the Dow 30 test that we ran previously. And again, this value was higher than 0.05. So per this test, we're showing that there is no statistical difference between the 2 groupings. Again, disproving our hypothesis. So, in conclusion, with the p-values greater than 0.05 for both the Dow 30 companies and the 10 technology industry companies, we're seeing that the ROE alone is not a good indicator of stock returns from a statistical standpoint. The industry-specific companies actually returned a poor statistical result with a p-value 2 times that of Dow 30. So what this tells us is that we can't rely on one ratio alone in making an investment decision. We need to take in multiple ratios into account, other information, and other research. Thank you.